Welcome back. The markets are in a good space, so good time to talk about happy things. And one such company that made a big announcement yesterday was Happy Forgings. It's approved a capital investment of up to 650 crores to expand the heavyweight forged and machined components. Mr. Ashish Garg, the managing director of the company, joins us on the show. Hi, Mr. Garg. First of all, Happy New Year and wishing you all the best for 2025. Y'all have started off with a bang. Big capex is what you've announced, particularly with regard to these machine components, and it's going to be heavier as well. So give us a few details. One is, what is the typical asset turn that you will get on this investment of around 650 crores? That would be what kind of revenue potential? And I understand that this could potentially be better margin, better return ratios as well. So in comparison to what you're currently doing, how much better can it be?
Happy New Year. Thanks. Yes, we have yesterday announced the capex of 650 crores through our board, and we are very excited for this investment. The move aligns well with our strategy to grow our business in the industrial sector. So this will help us in forging and machining components from 300 kg to 3 tons. So if you look at our history, we have always grown with enhancing our capabilities in terms of weight range. So this move will definitely help us in entering into different verticals like within industrials, like power gensets, which are used primarily as a backup for data centers, and it will also help us for marine application as well as railways and defense. So the typical asset turns on this project will be in a range of 1.2x. Depending on what portion of material is sold as machined, and typically ROCEs will be better than our existing business, but the testing periods are a little longer than the current business. So it will take certain time, 2 to 3 years, to capitalize on the full utilization of the capacities.
Okay, so how much better can the ROCE be, if you could help us out with that? And also industrials, I think you could correct me on this number, it was around 3-4% of your total mix, which went up, I think, to around 12%. With this coming on stream, industrials as a percentage of your total mix, it goes to how much?
So industrials will, the way we see it, the industrials will look at around 25-30% going forward on full utilization basis of this capacity. We have already touched around 10-11%, and with this we expect to touch around 25-30% going forward. This will also help us in enhancing our export percentage and also accelerate our profit margins.
Exports are 20%, right, of the mix. So that moves up to what levels? So what is the desirable levels? And getting back to that point on margins and ROCE, how much better?
So in terms of, if I can say in terms of gross margin, yes, this will be around 10 to 12% better than the existing average today. And in terms of ROCEs on full utilization basis, we can also look at upwards of 25%.
Okay. Let's also talk about the funding, Mr. Garg. I think it's a mix of internal accruals and debt as well. So if you could just update us, what is the cash level at hand? How much will it be through internal accruals? And again, the debt that you already have in the balance sheet, and whether you'll be taking any additional for this.
So currently we are net cash. We have 250 crores of cash on the balance sheet. And for this investment, and we are looking at upwards of 300 crores of cash accruals going forward for next 2 to 3 years. So we won't be needing enough, debt for this. It will be majorly funded through our internal accruals. Besides this, we'll be having another capex of 350 crores on our existing line of business, which is also factored in. So in cumulatively, we are looking at over 1,000 crores of capex in next 3 years. And majority of it will be funded through our internal accruals.
Okay, let's talk about the overall outlook, because I think most on the street are expecting you to do a much better, much more solid second half. Are those expectations well placed? And also, how many years will it take for this new facility, the capex that you've just started now? When will it start contributing to the revenue? And once it's fully on stream, then how do we look at the revenue profile?
So we anticipate productions to start in Q4 of FY27 and beginning of FY28. And it will take 2 to 3 years to streamline the production on this capacity, as testing periods are long. So you can say that, within 2 to 3 years, probably we will be running up the revenues from 600 to 800 crores on the new facility.
600 to 800 crores. 800 crores would be when the new facility is on full capacity. Now, just talking about the company's current revenues, I mean, your business as it stands now, what is the kind of improvement or recovery that you're expecting in the second half? Because the first half, the revenue growth has been a little muted, most on the street feel, as it's been, I think, in single digits.
Yes, you're right. So underlying industry is witnessing a slowdown, whether it is farm equipment or commercial vehicle sector. We have started seeing some green shoots on the farm equipment side. And it's a little early to comment on it because we have just seen December, and it was a mixed season. So different OEMs have posted different numbers. Some has shown growth, whereas some has shown decline as well. So we need to see this quarter, particularly in terms of the deliveries they do at a retail level, to actually conclude if there are actually improvements in the market. On the CV side, the demand for multi-axle trucks is still low, and we are kind of getting a mixed feeling. We still need to see, couple of months to actually confirm that the market is doing well. But definitely, market is not further slowing down, and we are at a reasonable level. When it comes to the export sector in a European market, yes, we have seen a sequential dip in last year, quarter-on-quarter degrowth in terms of farm equipment sector as well as commercial vehicle sector in European market. North American market also has seen a sharp slowdown, especially when it comes to farm equipment sector. But we see that recovery, we are at a bottom right now. There is a lot of inventory action which has already happened. And we will be looking at some positive moves, but it'll be too early to comment, on recovery.
Ashish, but for this year, what should we work with? Low single digit revenue growth for this year?
Yes, so we should be looking at, at a moment, we should be looking at kind of a single digit growth.
And so 4-5% growth, revenue growth for the year?
I won't be able to comment for the entire year. For H1, it was a single-digit growth because we are trying to grow despite of commodity prices slowing down. So we have to see how the commodity prices will be in H2 for us. And also at the same time, we are working on certain new projects. So H2, it was around 6 or 7% growth despite of raw material prices falling. And H2, we have to see, what is the degrowth in the commodity prices. But we are on the new projects, and company's machining business, which is a crankshaft business, has seen 15% growth, which has us in improving our gross margin by almost 300 basis points in H1, which has helped us improving our EBITDA margin by almost 1.5%. So the EBITDA growth is over 15%, and we expect this to continue going forward as well.
Okay, so better margins will hold steady. On the top line, there's a bit of uncertainty. Final question before we let you go. You won a crankshaft order in the beginning of December from one of the domestic PVs. And PVs is something where you managed to make an entry point in the last 12 to around 18 months or thereabouts. Could you tell us, is this order win from an existing customer? Is it from a new customer? I think you had added Mahindra & Mahindra, in the recent past. So is it from a new client or is it from the existing one?
It's from the new client.
Okay, could you name it?
I'm sorry, I cannot name the client because of confidentiality agreements, but definitely it's a new client.
But good to hear it's a new client as well. That means you're making inroads into the PV segment, which was just a very, very small part of your business. Thanks a lot for joining in, Ashish. Wishing you all the best for 2025.
All right, that's happy Forgings, and we'll of course track the progression there. Look at the